So, Mr. X has 2 lakh investment in his business firm. He wants a 15% return on his money. From an analysis of the recent cost figures, he finds that his variable cost of operating is 60% of sales. So, variable cost is 60%. His fixed cost is 80,000 per year. Show computations to answer the following questions. What sale volume must be obtained to break even? So, we need to find the sales. Break even sales we need to find. So, in order to find the break even sales, what is the formula? Break even sales is equal to fixed cost by PV ratio. Break even sales equal to fixed cost by PV ratio. In the question, we are given variable cost ratio as 60%. If variable cost ratio is 60%, what is the PV ratio? 1 minus variable cost ratio, that is 1 minus 60%, that is 40% will be the PV ratio. If we get variable cost ratio, we can directly find the PV ratio. 60%, then PV ratio is 40%. So, fixed cost is also given in the question. He incur 80,000 per year. So, break-even sales is equal to fixed cost by PV ratio. 80,000 by 40%, 2 lakh will be his break-even sales. Next question. What sale volume must be obtained to get 15% return on investment? He needs to get a return on investment 15%. He needs to get a profit. So, what will be the required sales? We have a formula for that too. The required sales equal to fixed cost plus desired profit by PV ratio. What is the required sales? Fixed cost plus desired profit by PV ratio. What is his desired profit? He desired a profit of 15% return on investment. Desired profit is 15% on investment. Investment is 2 lakh. So, what will be his desired profit? 15% of 2 lakh, that is 30,000. Fixed cost is given in the question as 80,000. So, required sales equal to fixed cost plus desired profit by PV ratio. 80,000 plus 30,000 by 40% gives 2,75,000 as the required sales. And the third part is Mr. X estimates that even if he closed the doors of his business, he would incur 25,000 as expenses per year. So, this 25,000 is an unavoidable fixed expense. At what sales would he be better off by locking his business up? So, we have to, what sales would he be better off by locking his business? When the sale is at what level, it is better to close the business. So, we have to find the shutdown point. We have a formula to find the shutdown point. Shutdown point is equal to avoidable fixed cost minus reopening cost by PV ratio. Shutdown point is equal to avoidable fixed cost minus reopening cost by PV ratio. So, what is the avoidable fixed cost? He incur 80,000 fixed cost per year, and among that 25,000 is unavoidable. So, from a total of 80,000 fixed cost, 25,000 is unavoidable even if he closed the doors of business. So, what is the avoidable fixed cost? Avoidable fixed cost equal to total fixed cost 80,000 minus unavoidable fixed cost, that is 25,000. We get 55,000 as avoidable fixed cost. So, shutdown point will be avoidable fixed cost 55,000 minus reopening cost. It is not mentioned in the question, so it is nil. Divided by PV ratio 40%. So, 55,000 by 40% gives 1,35,000 as the shutdown points. So, if his sales is less than 1,37,000, if sales less than 1,37,500, it's better to close the shut down the business. Hope it is clear.